Hey guys, Jared Wesley here of Live Traders, and it's that time of the week. It's lecture time, and this week's topic I think pertains to just about every single person out there, and if it doesn't, it should. This week we're talking about two things. One, we're going to talk about the market, okay? What is currently happening in the market. This volatility that we've been experiencing, this pullback in the market, the downturn, the coronavirus and how it's affecting society and the economy, and as that relates or how that relates to the stock market, why more people aren't invested in the stock market, which is crazy. I'm going to show you a chart that will surprise you. In fact, there are fewer people invested in the market today than there were 10 years ago at the bottom or even right before the financial crisis. Why? I don't know, because the average person is not terribly bright, I suppose, when it comes to investing. So today I'm hoping to change that. So one, the first half of this lecture has to do with long-term investing, swing trading, core trading, and investing long-term, and how you can take advantage of this market and the pullbacks that we're likely experiencing, or I should say we are experiencing and likely will get worse. Okay, then I want to talk about a little bit about intraday trading and swing trading and how you can simplify your approach to trading. But you definitely don't want to miss the first 15 to 30 minutes of this video, because I talk about the current market and how you can better take advantage of it, not necessarily for trading, but for your long-term portfolios, your 401ks, your IRAs, your retirement accounts, your investment accounts, etc., and so forth. Because what happens is people are panicking, and when people panic, they do stupid things. No, that's actually statistically accurate. There are studies that say when fear creeps in and people are overly stressed, their emotional intelligence actually drops, right? Hence, the run on toilet paper. Do you really need 96 rolls of toilet paper right now? No, I talked about it last week. But what you need to understand now is how the stock market operates and how you can better take advantage of this pullback in the market so that 5-10 years from now, you're sitting pretty. I made a lot of my money, guys, back in 2010, 11, and 12 by buying up real estate and investing in the stock market at the bottom, and now you're sitting pretty. You can do the exact same thing, and like I said, the second half of the lecture is about simplifying your approach to trading. All right, so let's get to it, guys. There's about a 40-minute video or so. It's not terribly long, but like I said, packed with a lot of great information, some interesting stats you probably didn't know as well, like I said, as how you can navigate through these difficult and challenging times. And obviously, what better business to do than trading if you're going to be stuck at your house? And another thing that's important too, guys, is even if you're not super duper into trading, you should at least have basic knowledge of investing. You really need at least basic knowledge of investing. We have proven, and I'll show you in the lecture, that hedge funds and money managers aren't very good. They're terrible, actually, okay? They always tell you that, hey, we don't get all the upside profits when the market shoots up, but we protect you on the downside. Statistically, it is not true. Statistically, they lose more money than the market on the downside, and they make less money than the market on the upside. Okay, so it's something you want to consider. Also, just as a side note, our swing trading newsletter right now is up 12% for the year, and the market is down 25%. We are up on the market 37 points. We're beating the market by 37% this year using a simple approach. You can get a $1 trial to that, guys, 30-day $1 trial with the link in the description. You could also check out our chat room for $1 for 14 days. That link is also in the description. If you like this video, please hit that like button. And as always, come on, smash that subscribe, right? You want to subscribe. There's lots of great content here. Every week we're putting out great content, all right? So I'm Jared Wesley, guys. Let's get to it. Today's topic, market outlook and simplicity. So we're going to start out today talking a little bit about these markets in general. These as in what we've gone through here over the last, I don't know, 3 or 4 weeks. And we're going to talk about how to simplify your trading a little bit. And what kind of brought this on, all right, was just, I want to say dumb luck in the sense that, and this is true, I typed should I, and I was looking for something completely different. I won't tell you what I was looking for. And as I typed should I in Google last night, and you can see it was late last night, the first thing that came up was should I buy stocks now? And I don't know if that's true today. All right. I would love to see a search history. Ooh, let's not go there. Anyway, should I, and it's should I buy stocks now? And I thought, wow, if that's the first thing that comes up on Google, okay, then obviously there's a lot of people thinking about this topic, because I was actually just going to talk a little bit about simplifying your trading today. But I thought it might be a good time that we discuss what's going on out there in the world with related to, to this virus, as well as how it's affected the stock market. And then this confirmed that for me. Okay. So you look at this, should I go to work? Should I refinance my house? Should I stay at home? Blah, 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 blah. Okay. I found this one to be very odd. Should I get bangs? I guess that's for the ladies out there. I don't know, but everything else is very interesting. But the first thing that comes up, okay, is buying stock. Now, why would I possibly think that that's fascinating or interesting? Okay. Because I want to show you guys something on the next slide that might surprise you, because I was really surprised by it, okay? This is the percentage of Americans who invest in the stock market. Currently, as of last year, it was roughly 55% of Americans. Now, here's the fascinating part. It's down from 62% in 2008. Guys, what happened from March of 2009 till about a month ago, give or take? What happened from March of 2009 till about a month ago? For those of you that are living under a rock, we had the longest, I didn't say largest, I said the longest rally in U.S. stock market history. And I think as a percentage, it was the second or third highest ever. But in terms of length of time, the longest ever. And yet, 7% less, 7% fewer Americans were in the stock market at this time. What does this tell me? Well, for me, it tells me a lot. Americans are very foolish with regard to their retirement portfolio, and either a couple things. One, they don't trust the stock market after what happened in 08 or 09, or they're just naive. Okay. Now, some people are going, well, geez, I'm so glad I didn't invest in the market, back in 2009. Well, actually, that's a foolish comment, because the Dow was at about 6,000 or 7,000. And even with this pullback, the Dow is at like 20,000. Okay. You'd still have 2.5 times more money had you invested in the market back then. Okay. My point I'm making is the average person has no idea what is going on in the world, and the average person is always late to trends. Now, tell me if this next slide does not make a lot of sense to most people out there, or you have at least thought about this from time to time. Are you ready? Let's take a look at this. Now, I want to give credit to whoever posted this out there online, because it's not mine. I did not make this, and I want to give credit to you. I just don't know who you are. So if you see this on my video and you want credit for it, just tell me. I'll throw it in. So let's start on the left, okay? 5%, minus 5%. Oh, normal pullback. Minus 10. Oh, just a healthy correction. Minus 15. Stocks are on sale. I love a good sale. That chop around, chop around, chop around. Oh, get to minus 20. Well, let's see what happens. I'm going to sit on my hands here. I'm not going to do anything, right? And we're in this range right now. Ooh, minus 25. This is kind of starting to feel serious. Things are starting to get real. Okay, minus 30. Oh, shit. I can't touch this money for another 15 years. Minus 35. What is happening? I'm getting ready to walk off a bridge here. This is crazy. This is insane. The world is going to end. Oh my gosh. And then it gets worse. Minus 40. F it. I'm out. Done. Screw this. F Wall Street. Stocks are dumb. The world's going to an end. Right? Minus 45, Thank God I sold. Thank God I got out of the market. Minus 50. You know, I'm probably going to get back in soon, right? Minus 55. I'm never coming back. Ever. Okay? Done. Right? As somebody's saying, I'm going to buy a toilet paper factory. Screw the stock market. Okay? I need some hand sanitizer and a toilet paper factory and we'll get it all back. Okay? Guys, I understand that this goes a little extreme with minus 40, 50, 55%. But tell me that you all haven't thought a little bit this way at some point in your portfolio. See, it's one thing when you're young, right? And you go, oh yeah, the market's down 20%. Feel bad for those people. But when it's your money and you're 40, 50 years old and your 401k, your IRA is down 20, 25, 30, 35, 40%. Ouch. Now, what I didn't do, which I wish I would have done, is go back to 08 and 09 and pull out some comments, some social media comments. Because I've never in my life seen more social media comments in 08 and 09 that said, screw the market, F Wall Street, I will never invest in the market ever again. Right? Tons of them I saw. And the market ultimately got in the 40% range, 35, 40% down, right? And then what did it proceed to do for the next 10 or 11 years in a row? It went up 400%. Okay, 400%. The point I'm getting at all of this, guys, is the average person is always behind the trend. You know, Warren Buffett said it quite eloquently and simply when he said, you should be greedy when others are fearful, and you should be fearful when others are greedy. When you see this happening in the market, consider it a blessing. It's not a blessing if you're 65 and you just retired. You're going, shoot, I just lost 40% of my life savings. But if you're more than 10 years away from retirement, this is an opportunity. And I'm going to talk about that here in just a minute. Okay, I'm going to talk about it here in just a minute. Okay. I'll go over this a little bit later, guys, but I just wanted to show it. I'm going to go over a few charts and I'm going to come back to this. This is the stock market over the last 125 years. Okay, this is the market over the last 125 years, listed for every event that's happened and every major event that's happened, I should say. And this is just a general chart of the market. Okay, you'll note one main thing here. It goes up. Let me repeat that. It goes up. Okay, yes, there are times right here in the middle where it gets absolutely unequivocally nasty. Straight up, wow, nasty. And it still goes up. Okay, all right. Now, if you think, oh, well, maybe this is a really good time that I should be contacting a financial advisor and getting their opinion on things. This is a comment from somebody online, and I thought it was appropriate. Okay, I don't know who this gentleman is, but the hedge fund industry has justified underperformance since 09 that they won't catch, okay? They won't catch 100% of the upside in good years, but they will provide downside protection when the market falls. Trust me, guys, this is the truth. From my own financial experience in life, from having very good friends that are hedge fund managers, this is the truth. They always say, we'll never get 100% of the upside, but when the shit hits the fan, we got you. We have your ankles and knees protected. Well, in 2018, the S&P returned a minus 4.5%. It lost 4.5%. Hedge funds lost 5.7 on average across the board. So much for that theory, huh? What I'm trying to tell you is most financial advisors, not all, they're not all bad people. They're not all poorly intended. That's not what I'm suggesting. I'm just saying their results don't bode so well for them when you look at history. They don't catch the upside, and they take most, if not all, of the downside with them. Does that make sense? So you don't get the upside, so the downside hurts even more because when the downside happens, they lose just as much as the market or more than the market. Okay? So think about that for a second. So then you go to yourself, well, geez, Jared, what do you do? Well, maybe you should take it upon yourself. And no, this is not a pitch for live traders. I know you're going to think it will be. Maybe you should take it upon yourself to learn a little bit about the market. I mean that. Learn a little bit about the market. Learn how things work in the world. I understand that not everybody out there has 8 hours a day to talk about the market, think about the market, and become Warren Buffett. But you better darn well think about learning a little bit about it. Why? Because you go to work every day, 40, 60 hours a week. You put your money every month into your 401k, your IRA, other investments, and you don't know jack schniznit about what's going on in the market. How do I know this? Well, one, most of you aren't even invested in the market. Well, technically, most of you are, but the percentage of people in the market is decreasing during the largest or longest bullish run we've ever had. Think about that for a second. Most of you are going backwards in life. Everybody complains about the wealth gap, right? The gap between the rich and the poor is too wide. It's about to get bigger because they're still invested in the market. They still have some money left over when you don't because you didn't invest in the market. Okay? So, let's talk about the market. This is the S&P 500, right? Okay? Which is pretty representative of the larger market. A lot of people focus on the Dow, but let's be honest. What's the Dow 30 really? It's 30 stocks. The S&P 500 is a much broader, better perspective of the overall market, better than the Qs, the NASDAQ, etc., in my opinion. So that's what I'm focusing on today. So when we look, right, at the market, this is the weekly chart. We'll take a quick look at the monthly and the daily in just a moment. But this is the latest run we've had as of yesterday. This doesn't include today. But as of yesterday, we dropped from just under 340 down to just under 240, about a 100-point drop. Today, we're sitting at what? 238, 239. Now, I put lines on here because this is your education. You may not know much about the market, but you're going to learn at least a little bit today. When the shit hits the fan, right? You heard the real estate phrase, when there's blood in the streets, it's time to buy real estate. Stock market's the same way. But, and if anybody tells you otherwise, they're lying to you. Nobody knows the floor, right? Nobody really knows the floor, okay? We can speculate where the floor is based off charts, based off economics, whatever. We use charts because we're technical traders. But the thing is, people think, oh, you're just day traders. No. A 1-minute chart can move up to a monthly chart, can move up to a yearly chart, okay? So the patterns and human emotions don't change on a 2-minute chart versus a weekly chart. Fear and greed, the need to be right, they still drive the world. Ego still drives this world. Fear, greed still drives this world. So when we look at a chart, we're talking about the flow of money. And the flow of money is all that really matters because guess what? Actions speak louder than words. You can say something, but what people do is far more important than what they say. And the chart is telling us what people are actually doing. And that's important, okay? So we can say, oh, this virus isn't that bad. But the economy or the people invested in the market, which is most of the time, quote, the smart money, is saying otherwise, that this is a very serious thing. And we should take it that way and things might get worse. How do we know this? Because it took, what, from October of 18 all the way up to January of 20, so what, 15 months to do this, to go from 240 to 340. And guess what it just took? 1 month, 4 weeks to give it all back. So what took 15 months to make took 1 month to disappear, which means they're taking this pretty seriously. Okay? 3 to 4 weeks of craziness took out 15 months of bullish buying. So, how does that affect you? Well, one, do not sell your stock portfolio. Just don't do it, guys. Okay? Long term, this will bounce, will be okay. Will it be a year? Will it be 10 years? I don't know. It could be a very long time before we bounce from this. But what I want to talk more about today is buyable opportunity. So in the long run, nobody knows where the market bottoms out. But we do have levels you can consider. So on the weekly chart, 233.50 is a level where you should start considering buying up a little bit of stock. So if you have a portfolio, and you should always have some cash in your portfolio, right? And you want to start going, well, where's the bottom? Is this, right? Go back to Google for a quick second. Should I buy stocks now, right? It's amazing that that's the #1 search on Google after you type in should I. But anyway, So now you're looking at this and you don't want to be dumb and just randomly buy the market. Go, oh, I'll just randomly put money in. Buy it at support levels, okay? Because these are areas where markets typically bounce. But you don't want to go all in an environment like this because we don't know how bad this could get. And I'll be honest, this could get epically bad. The market's down 20, 25% right now. We could be down 40 or 50 or 60% in another month. I really don't know. But the point is, once we hit these levels, 233.50, add some stock to your portfolio. Okay, now I'm not talking about the people that are retired at 70. I'm talking about the people in their 20s, 30s, 40s, and even 50s. You want to add on the way down, but you want to add incrementally. Okay, so you're going to buy some here at the 233.50 level. You're going to add some more if we get down to the 180 level. Why? Pivot, bounce, pivot, bounce, pivot, bounce. Okay, you want to add a small percentage, meaning this really depends upon how much liquidity you actually have. And I can't give you an exact percentage of this because it also depends on your position in life. Some people are more risk adverse, some are less risk adverse, some are closer to retirement than others. Okay, meaning some people actually need certain amounts of cash to live upon. Not everybody has a 10, 20, $50 million portfolio. You might have a $200,000 portfolio, an $800,000. You might need certain levels of cash to sustain your lifestyle over the next year. So obviously in that case, you're going to put less of that portfolio into this. If you have a lot of money, 10 million plus, 5 million plus, and you're in your 30s or 40s, I'd be adding a lot at each one of these levels, okay, 233.50. So basically, I would take this and divide it into 4 levels. So let me go to the next chart, all right? I would divide this scenario into 4 levels and divide your cash into 4, all right? So if you have 10% of your portfolio in cash, obviously leave a percent or two. Take 8% and go 2% add here, 2% add here, 2% add here, 2% add here. God forbid we get back to $67 on the SPY. If we go from 340 to 67, that's scary. I'll just leave it at that. I don't want to comment on it. That's scary. Okay. But I would add, take your available cash, leave some cash in there. And again, it depends on your personal situation. Okay. And add on the way down. Now, if we break 233, which we're sitting at 239, we're not that far off. Okay. It's going to get ugly. The next area of support's at roughly the 180, 181 area. This is the monthly chart of the S&P. And by the way, before we get back into the negativity and how nasty this has been, guys, this was the bottom in 09. 67 up to 340. That's what? A 5-fold increase? 500% bounce from the bottom. From the top, it was what? 240, 250%. Even from the peak, guys, the very peak at 160, it's still more than double that peak. Okay? So you should be adding to your portfolio on the way down. And I want to be very clear about this. I am generally not, as a trader, somebody who cost averages losing positions. But this is different. This is a long-term core 20, 30-year investment, okay? This is not a swing trade you're in for 3 days or 5 days or an intraday trade you're in for 35 minutes. This is different, okay? But over the next month, 2 months, maybe 3, 1 to 3 months, you should be looking at the market as the world's biggest buying opportunity. I'm not kidding when I say this. These are the areas you should be considering. 233, 181. If we get past 181, tough. Now, could you say this area of 150 is also some support? Yes, you could, right? You could say the top of this pivot, and I could do that right here. Actually, let's use this one, right? Just copy this and paste it so you guys can see what it looks like. That area is another area to consider. Why? Because that was the top before, all right? So we have 3 or 4 areas here that you guys can consider as buyable opportunities, but you should be buying at each one of these price points, okay? This is the monthly chart. You can see, big picture, what has happened so far is not the end of the world, but it could get really bad here in the next month or two. Instead of running for the hills and what? Looking like this, I hate to say it, guys, and I don't want to be rude. This is the chart of an idiot. This is what dumb money looks like. I'm not being rude. I'm just telling you the facts. This is what dumb money looks like. I'm out. Well, why would you ever sell after 40%? This chart right here should give you a lot of confidence that things always bounce. And if this doesn't give you enough confidence, guys, if this doesn't give you enough confidence, then guess what should? This. Because as up until this point, the country has never seen anything worse than the Great Depression. Could this be worse? Maybe. I don't know. But we've never seen anything worse than this. And yet the market still climbed and climbed and climbed for the next almost 100 years, 90 years since then. Okay? So what goes down always comes back up. The question is, what is the time frame for the bounce? And the other question is, what is your alternative? Really, what is your alternative? When the market gets hammered like this, real estate gets hammered like this. In this particular case, gold is not even a safe haven. All right? The market will bounce. We just don't know if it's going to be 1 year, 10 years, or 20 years time. Maybe longer. But the market will bounce. So if you buy on the way down here, like here, it doesn't take 25-year recovery. Now remember, when you see 25-year recovery, some of you guys are going, oh my gosh, that's ridiculous. That's half my life. Guys, that's if you bought at the very top. That's for every person that literally bought the market at the tippy, tippy, tippy top. Most of people were buying on the way up, so their cost average is much lower than the tippy top. And if you buy on the way down, your cost average should be somewhere in the middle or lower half of this. So you actually got your money back in about a 7-year period here, not 25. Does that make sense what I'm saying? So be smart. Don't do this. This is insanity. Insanity. And this is even more disappointing to me. 62% were invested in the market in 08 and only 55% today. You want to know why the average American's broke? Well, it has a lot to do with spending habits, but it also has a lot to do with not investing in the market. Sure, debt is number one, poor spending habits, but this is also a big factor because of what? The emotions that coincide with it. Don't be that person. If you do, you'll always be behind the trend and you'll always be complaining about rich people. They just made better decisions than you. Just admit it. They made better decisions than you. You all think the rich people are a bunch of trust fund babies or something. They're not. Most money in this country is self-made. They just made better decisions than you. So now let me move on to something else real briefly. And we're going to go away from swing trading, core trading, right? Investing for a second. And I want to talk about this recent environment, okay? Guys, this is what volatility looks like, okay? This is the S&P 500 on the daily chart over the past 3-4 weeks. $15 to $20 trading ranges. The average trading range for the S&P 500 is $1 to $3. It's 15 to 20 right now. The volatility is at an all-time high. I think it was Monday of this week. I read an article that said the VIX, the volatility index, was at a record high. It had never been that high. Now, why am I bringing this up? Because I'm shifting gears from long-term investing, protect yourself, buy on the way down, and in 5 or 10 years, you'll be happy you did. Most people ask me, how'd you get all your money? I said, I bought real estate when nobody else had money. 2009, 10, 11, and 12. This is a true story. I bought 7 industrial real estate properties. Every single one of them has gone from at least double to 4x. I have properties that are over about 4.5 times what I paid for them. The worst property I bought is double what I paid for it. The market will do the same thing. The market will do the same thing, okay? Prepare now, so in case this happens again in 20 years, you'll have money when nobody else does and you'll buy stuff up cheap. But this chart specifically is talking about intraday trading, okay? This environment is ripe for the wanna-get-rich-quick crowd. This environment is ripe for the wanna-get-rich-quick crowd. In fact, you guys in the chat room were talking this morning how somebody made 100,000 on BNTX or 200,000 on BNTX. It's straight gambling. It's straight up gambling. We also talked about one other thing. What's the biggest problem that gamblers have? I'm not talking about professional poker players, guys. What's the number one problem that gamblers have? They don't know when to walk away. They don't know when to quit. So what am I seeing out here? Not just from people I know, not just from other gurus online. I'm seeing a lot of people trying to catch a ride on these biotechs. Ooh, the coronavirus. What biotech is going to come up with the cure? Let me figure that out. And they're all trying to catch a ride on these biotechs and make $1 million overnight. It's not going to happen like that. Most people end up, instead of getting rich quick, they end up getting poor quick, right? That's what happens to most people. So yes, you might think you're different, but you're not. You will likely end up getting poorer quicker than getting richer quicker. Stick to your guns, stay out of trouble, use good money management, and if you're really new, like brand new, like last 1 to 2 months new, beginning of the year new, sit on the sidelines during this or lower your risk to like $5. You don't want to be hammered in this. You guys, we traded Amazon yesterday. I saw in a 30-second period Amazon move up and down $30. $30 up and down in less than 30 seconds. You don't need that kind of trouble. Lower your risk. Stay away from the volatility. This type of environment will eat up, spit out, and chew up new traders. I get it. You're thinking this. I understand the thought process. Oh, this potentially could be a once-in-a-lifetime opportunity. Man, if I get in this biotech and it gaps up like $32 and I buy 1,000 shares, I'll make 30 grand. I'll be cool. Or I'll buy 5,000 shares, I'll make 150 grand. And what happens if it gaps down $10? You blow up your account, right? You blow up your account. Somebody in the chat room made a really good comment. I'm paraphrasing, but a really successful winning streak for new traders is the worst thing that can happen to them. It gives them a false sense of two things: a false sense of experience, that they're better than they really are, and a false sense that this business is easy. That's the worst thing that can happen to new traders. Okay? It's the worst thing. So don't fall prey to it. You're going to have a lot of people telling you, oh, buy this biotech, buy that biotech, right? I can't believe you didn't short this market. Guys, side note, we have a swing trading newsletter that's up 12% this year and the market's down 25. We're up 12 and the market's down 25. And somebody said, I want to cancel the newsletter because you guys didn't short the market when it tanked. How did you miss that? I kid you not. I got an email from somebody. You didn't short the market when it tanked. How did you miss that? I said, we're beating the market by 37%. We're destroying the market right now. How is that not good enough? Because guess what? It's the get rich quick mentality. We're not Houdini. Who knew that the market was going to go from 340 to 240 in 3 weeks? Nobody, or very few people. Maybe some did. We're beating the market by 37%. It's not good enough. Not for some people out there, right? Think about that. Hindsight's 2020. We're all geniuses in hindsight. And we're not all Biff in Back to the Future 2, right? You don't get the sports book. So now that we're done that's a spiel on the market. I want to talk now, and I'm going to go through the second section a little bit quicker, how you guys need to be thinking about simplifying your approach a little bit. Simplicity is the ultimate sophistication. Da Vinci said that, okay? So think about this for a second. I'm going to go through this a little bit quicker. I have a funny video I'm going to play for you also, okay? Simple, it's easier to learn. Simple, it's faster to learn. Simple is also more efficient. You make fewer mistakes when things are simple. There's fewer things that could go wrong. Simple is just more effective, okay? It makes more money, right? When you think about golf or you think about anything, right? Having a golf swing like Jim Furyk, who, for people who watch golf, is a challenging way to make a living on the PGA Tour. He happens to be good at it. If you have a smoother, better swing, there's less things that can go wrong. So if you have a simpler approach to trading, there are fewer things that can go wrong, okay? So keep your trading as simple as possible. So think about this. What's really important to a trader? News, earnings, upgrades, downgrades, hype? Maria Bartiromo's opinion, Kramer's latest pick? Think about it. What's really important to you? Maybe Maria Bartiromo. She used to be anyway. No, I'm kidding, guys. The answer is price. Okay? Price. Nothing is possible without price. So why do so many of you guys and gals, why do you focus on everything except price? You focus on cloud cover, Fibonacci, stochastics, Bollinger Bands, and every other indicator in the book. Everything that's not price is what you're focused on, right? And we'll come back to it. And this is what your chart looks like. I don't even know what this is. It's worse than the Matrix. You know, the beginning scene in the Matrix. This is worse than that. You guys are focusing on everything that is not important, right? Price is what's important. So I want to show you guys something, okay? Because this, in my opinion, is what you guys are doing, okay? This is what you guys are doing. Have a laugh for a second. That's you guys. Okay? That's what you guys are doing. All right? I hope the volume was loud enough that you could hear that. You're trying to fit a round peg into a square hole or a square peg into a round hole. Okay? That's what you're doing. Because, guys, what is our job? Our job is to match pictures. Really, our job is to match pictures. You ever have one of these toys when you were a kid? Right? Circles in a circle, square goes into the square, you know. And what is this? What age group is this toy appropriate for? Like 2-year-olds? Really, seriously. It's appropriate for like 2-year-olds. So when you think about that, what are you doing? Now let's try a little exercise. It's going to be challenging. So I want you guys to put your thinking caps on. It's going to be really, really tough. You ready for it? Are you prepared? Okay, find the matching object. Find it. I know it's hard. I'll give you guys an extra 15 seconds to really think this one through. Okay? Just in case you're curious, you're trying to match this on the left to something on the right. Okay? I know it's tough because there's two that are very similar. But we joke about this, but this is what your job is every day. And I know some of you are going, is this a trick question? No, right? Your job is to take the picture from the textbook and match it with the reality you see in the markets. And preferably try not to put a round peg in a square hole. Okay? Think about it. But this is what most of you are doing. Because your charts look like this. I don't even know where to start here. I'm confused. Like, it's like one of those puzzles where you have to, you know those puzzles you have to really stare at? And once you stare at them long enough, a picture forms? You know the ones I'm talking about. You know, I think Dave Matthews had that on the cover for those of you that are like, you know, over 40. Dave Matthews had it on the cover of one of their albums, Under the Table and Dreaming, right? You stare at it and you stare at it and you stare at it and a picture finally forms, right? That's what this chart is like to me. I got to stare at this and stare at this and stare at this until I can, are they red and green candlesticks behind all this? Okay. And you guys are doing it all the time. Here's a different version. Are there enough things here? I mean, eventually you'll find what's important. And what's important is price. That's it. So I've talked about this topic before, but you guys, I see it through emails I get when people attach charts to the emails. You're overcomplicating the process so much, it's not even funny, right? Is this one missing stochastics? Darn it. You know, now we definitely can't trade. There's no stochastics on it. Now look at it this way. What's on this chart? Is there a need for anything else? Where's the trade? I put the volume at the top just so you know, but there's not even volume on this. There's just price, right? That's it. There's just price. And I think most of you could easily find where the pattern is. And if you can't, well, you're just starting out, I guess. But right here, right there, like 61.25 or something like that, there's a bicep. The stock moves up, breaks above supply, which is resistance to the left, breaks above, pulls back about 50% at what? Minor price support to the left. If you had a moving average, it would be right there. All right, you have a little doji bar, etc. Most of us can find that without, wait for it, without that. Like, what are you doing? You guys have no idea how many emails I get about, but Jared, it was a MACD crossover, but it was a Fibonacci retracement level. It had to bounce right there. I just shake my head like it takes a lot of patience to get through those kind of emails when I get 100 a day and 20% of them are just like, really? Are you kidding me? And it goes back to this. Just focus on what's important. Take a picture of a pattern without all the garbage overlapped on it and match it up. That's it. Let's go back to it. Does it really look that hard? This is not a conversation about money management or trade management. It's just about pattern recognition. It doesn't need to be as hard as you guys are making it, right? Here's one that does have a moving average on it. But again, wide bar, narrow bar, rip. Wide bar, narrow bar, rip. Okay, that's it. You could just erase the blue line, erase the red line. You don't need them. Okay, now, let's put them side by side. I don't know about you, but one of these charts is a lot easier to read for me than the other one. I look at this, and I don't even want the blue line and the red line here. I just want them erased. I'm just going to look at the price. I see the 3-bar play. It's gold. I look over here, and I don't even know what to do with this. Like, how many lines are on this? I can't even count. 20, 30, 40 lines between all the diagonal lines, the moving averages, the sideways retracement levels, all this stuff, stochastics down here. I mean, this is insane, right? It's crazy. Stop. Let's do it one more time and we'll call it a day. One more time. Match the picture. Match the picture. Let's do it one more time. What do you guys think? You're trying to match what's on the left with what's on the right. I know it's tough. Okay? I know it's tough. A, B, C, or D. I think most of you are going to get the answer right. The reason I put C in here is because I get way too many people that tell me this is a 3-bar play. It's 3 bars up, ladies and gentlemen. This is not a 3-bar play. It's right here. It's D. For those of you that were having trouble, Grant, it's D. Okay? It's not B. It's not A. It's not C. This is what your job is. Take a picture and match it. Take a picture and match it. And when you find the matching picture, you take the stock, wide bar, narrow bar, and you ride it up to your target and you make money. That is it. That's what you do. Wide bar, narrow bar, done. Why are you making this so difficult? And I'm not just touting the 3-bar play here, obviously, because this chart is a buy setup, right? This should go for all of your charts, all of your patterns. Unless, of course, you want to be like that kid in the commercial. All right? So that will do it for this week's lecture. All right? I hope you guys found that somewhat enjoyable. We talked a little bit about simplicity and a lot about what? A lot about the markets and buyable opportunities, levels and areas in which you could take advantage of this pullback in the market, and that you do not, trust me long term, coming from somebody who's taken advantage of this 10-year run, you do not want to be this. The last thing you want to be is this. This is what a fool looks like, okay? And unfortunately, the trend doesn't lie. 7% less Americans are in the market today than they were 10 years ago. And the market just had the longest bullish run in history. It's very, very sad. I'm not suggesting that it will be easy and that there won't be some pain. I'm not suggesting that. But you have to take advantage when the market pulls back, because it always bounces back up. And guess what, guys? One last comment. If it doesn't bounce back up, you won't have to worry about it. I'm not kidding. If it, for whatever reason, never comes back, every business you know, including Apple, will be out of business and you won't have to worry about it. It'll be sticks and stones. It always comes back up. Okay? It won't matter if that happens. So, I hope that you guys enjoyed that lecture, and we will do it again next week. To get more great educational content, subscribe to the Live Traders YouTube channel. This way you'll get email alerts every time I upload a new video.